This monthly report specifically is a bit longer because this month was a transition month, transitioning out of a handful of the strategies that we had set up previously into the new ones that are delivering us the types of yields that we wanted, and obviously transitioning that to the market in the community. So there's going to be a lot of lines, a little bit more confusing, which just natural that's going to happen. But next month's monthly report will be very straightforward, and that will be easy to consume and easy to see what we're doing. Burning tokens, yes, FIP. We obviously our focus has changed, right? So from like a top level point of view with the DeFi Fund, we had a certain strategy and a certain focus before. A lot of it had to do with this long bias leading into the next market. Fundamentally sound. Makes perfect sense. But you have to wait for it, right? You have to wait for the plan to play out. Unfortunately, we don't live in a world where our industry likes to wait. And for good or bad, we had to adjust our strategy to not only play to that long bias, which we continue to play to that long bias, but also deliver value back to the market and to the users now. So obviously we pivoted to a slightly different strategy that's providing us distinctly different results. And as you can see, over the last roughly 6 days, we have started the process of moving the stasis market in the proper direction, and that will continue to be the case. So let me screen share the monthly report. We'll get started. Michael is working. Heaven forbid Michael ends up working today, so he will not be joining us. But let me screen share the monthly report, and then we'll go from there. Can everybody see? You can even see my tabs. So if you're looking at the screen share at the top, those are the tabs I have open basically all day long, every day. Those are my standard tabs. You have the trading view that's usually on Matic or ETH, the stasis market on Deck Screener, the stasis DApp, Revert, which is one of the platforms we use to track the ranges and performance of each individual allocation, the Uniswap pools page that is where I can see the list of pools for each network, and then DBank on the left. Again, just keeping an eye on the main wallets of the fund. So this is my standard setup, like day in and day out. This is what my whole system looks like. The Pornhub tab is on the incognito tab. That's a different window. All right, so let's get started on the this run through here. Obviously, we're talking about the month of September. As I stated before, the month of September was a month of transition, less focused on long-term value, long bias, to shifting to a more value gain now with a long bias. So summary, Michael writes these summaries. So if you don't like it, you can give Michael feedback that you don't like his summaries. I will not feel bad about it at all. So overall, the macro market was kind of choppy. We did have a green September, which was a nice surprise for us. But it took a little bit longer for the alts to bottom out, and then on top of that, if you were to look at the Bitcoin dominance chart right now, Bitcoin dominance is on the rise, which means ETH and a lot of altcoins are lagging behind. So it is something that it did have a bit of a delayed effect on the fund. Even though Bitcoin was green for the month of September, most altcoins were either flat or red for the month of September. So that does have a small impact on the fund. However, we have an opportunity now with the way we're running the protocol to cancel out or enhance macro market gains. And so after gathering investor feedback, we had several conversations within the community and in direct message that we needed to inject a sense of urgency into the protocol and the fund. And so, as you guys know, we have gone through this process of moving on from some of these low yield, long bias beta plays with our allocations into things that we still believe are going to have huge upside into 2024 and 2025. However, they're also strong performers when it comes to yield. And so, for example, one of our largest allocations is ETH ARB on the ARB network. And while I fully believe ARB is going to go to significant price levels along with Ethereum, I believe Ethereum is probably going to go above $10,000 at some point in 2025. That pool is also generating over 100% APR. So not only are we exposed to these two assets that we believe are going to have huge upside from a fiat value standpoint, their yield from the pools that we're engaged in is also delivering us currently on average about 100% APR. So in our minds, it's a win-win. We can maximize value now, but also be exposed to maximum beta price appreciation later. So so we kind of have pools that go in two different ranges. Our more conservative pools, like our Bitcoin ETH pool, that's going to range between like 40 to 55%. High performance pools that are still daily managed and active are ranging anywhere from 70% to 120%. I think a couple of them are like closer to 150%. But the nice thing overall with what we are seeing is the pools, the way we have them set up, don't need as much active management as we anticipated. So there are, I think, two pools that we've had to interact with every other day, like about every 2 days, which we kind of anticipated. But there are two other pools that we haven't had to rebalance or touch in over 10 days. And so we've found a comfortable range that the asset will move in, and we've set it over 10 days ago, and it hasn't had to be rebalanced. And at the same time, those particular pools are ranging anywhere from 70 to 120%. So it's actually kind of this Goldilocks zone for yield and for volatility when it comes to the protocol. So just some other notes. We exited a bunch of positions, kind of like I talked about. We exited the Fraximal position. We exited the real yield ETH position. We exited the Pika CLP position. We put all the Pika that we had into single staking because we do believe Pika does have a bright future when it comes to this next cycle. They have great tokenomics. It's just a matter of we would rather just have full beta exposure to single staking Pika. Single staking Pika also earns you USDC as part of the rewards, so that's attractive. But everything else we have moved into these concentrated liquidity pool positions that we are actively managing on a daily basis. So, DeFi Fund mutual or DeFi Fund monthly performance for August. You can see this is a 2-pager. A lot of these pools, like I said, we've already talked about. They don't have any initial value here. They don't have any initial value because they're new positions. And then when you get to the bottom of the sheet, all of these ones that have initial values that are now end of month values are zeros. Basically what you need to know, and I'll post this report afterwards like I always do, is we had about $9,800 in fiat value loss over the month of August, which isn't necessarily that bad given the way alts performed during the month of September. This is wrong. Where's Ian at? Is Ian listening? I can see him. Hey, Ian. The titles are wrong. It says August 23. It's supposed to be September. That's okay. So anyways, we're talking about September here. So these end of month values are zero because these end of month values are zero because we exited them and moved into new positions. So the key takeaway here is our fiat loss was about $9,800. And that was mainly due to altcoin performance during the month of September. Yes, Bitcoin finished in the positive. However, most altcoins were either flat or slightly in the red. And but that's not a big deal fiat wise because of our new focus on with what we're doing with the fund. So allocations here, we have Wrap Bitcoin, Wrap ETH is our largest pool allocation. Obviously, it's just a conservative pool. That one in particular doesn't need to be rebalanced too much, and it earns anywhere from 20 to 40% APR. And you have exposure to Bitcoin and ETH. Very safe, very conservative. Our next largest pool is the ETH ARB CLP. Like I said, that one, we believe in both of those underlying assets when it comes to their bull market potential, and that pool delivers us over 100% APR right now, given our current strategy. Turbo Go pool, that's a stablecoin pool. We are getting to the point now where we will be reallocating that once the incentives run out. We will most likely be moving that into another conservative liquidity pool like a Bitcoin ETH or something similar, where we can earn higher yield on it and have better beta exposure. I don't mind having some stablecoins stashed away depending on market circumstances, but we are getting to that point coming up to having where I'm not as concerned about having stable stash away as I am having beta exposure to the macro market making a turn into the green. So, but we still have these stablecoins stashed away. It's about 45,000. That's earning Sommelier and its own Go. Go is the Aave stablecoin. So that's earning yield. And then a lot of our other Wrapped ETH Op, Wrapped ETH Link. I'm a big fan of Link. We have our trading allocation, which part of that is coming back. Actually, our trading allocation, we pulled profits from it, accounting for $7,400 in profit over the last 3 months. We pulled profit from that, and we are currently using parts of those profits to acquire tokens and burn them. So that's what it's there for, and that's a stablecoin allocation as well. And so we have ETH SNX. SNX is one of those ones where depending on who you talk to, they love it or hate it. I am a fan of SNX. I think it will have another strong run in the next cycle. I probably have some nostalgic bias for it because I would participate in its pre-sale back in 2018. And then, but I do believe from an asset standpoint, it has some pretty solid potential. We have an RDNT pool that we just jumped into. That's an interesting one because we are torn on its long-term potential. I personally think it's going to run a good amount, but it has like intermittent huge spikes in volume, which create awesome APRs for doing CLPs. So this particular pool will run from anywhere to 150% APR up to 350% APR, depending on volume. And so and we're just collecting fees off of that trading volatility or that trading volume. So It's been working out well. We have ETH FXS. That's another one. FXS has been giving us a significant yield on our CLPs. And then we have single staking FXS. We have GMX ETH pool. We have single staking Pika, and then we have MDB at 1.4%. And just some dust numbers. Michael likes to put these operational assets in the chart. It's usually doesn't account for more than $1,000, and this can be anywhere from we bought $400-$500 worth of tokens at one point, or we spent $500 on operational costs at some point between the start of the month and the end of the month. That's why this is negative, $494. The big takeaways, the key metrics down here. Beginning of the month was 456. End of the month was 446. And this is the big one. So our big focus right now is on yield, right? So we're having this conversation about yield. And the whole point of this new strategy is to boost our yields for the protocol, to return to the users, and to boost the price. Ultimately, that's what we're here for, is to have passive income and have an increasing value of the token. The last 2 months, August and July, our yield was about $9,300 per month. It's okay, but it wasn't great. And our expenses were high enough that most, if not all, of that yield was basically being canceled out by expenses. So obviously, in order for us to take full advantage of the market changing for the better, we needed to cut expenses and increase yields. So starting in October, our expenses are right around $5,000, which is almost half of what they were previously. Great. And then in just 10 days of running this new strategy, basically pilot program, in September, we were able to boost the yield from 9,000 to 13,000. So extrapolate that over 30 days. If we were able to go to 9,000 to 13,000 in 10 days, if we can continue to optimize and grow this process, these yield numbers will be significantly higher. For example, we have 5 days of data for October. I've been calculating a running total of yield for each day, just keeping in the back of my mind. And as of yesterday, our projected yield number for October is $25,000. So essentially, we're going to more than double our previous strategy's yield output, while also cutting our costs in half. And so what does that mean? That means we can put anywhere from $700 to $1,000 a day towards the stasis market, whether it's adding liquidity, whether it's buying back and burning tokens, buying back and distributing tokens for some rewards, whatever it might be. So that's the reality of this new strategy within the DeFi Fund, is that we're taking this number that in August was 9,000. 10 days of this new strategy in September resulted in 13,000, and then a full month's worth of results in October. We fully anticipate that we will be north of 20,000 in yield. I'm hoping north of 25,000. So we'll see how volumes turn out for the month. We'll see how the yields turn out for the month. But the key is that this process is going to quickly change and add value to the fund in a way that I think, as the market turns, as we move towards halving, they will start to compound on each other. And then the fiat value gain or loss on the DeFi fund is going to swing heavily into the positive because of these two changes. So that's the big takeaway for us. Treasury allocations. This list is just kind of giving you a breakdown of operational balances, LPs, farms, kind of what we have within the protocol itself. Right now, it's 500 and essentially 40,000. Like I said, we're not paying big salaries. We're not spending a significant amount of money on any major expenses. Like I said in the weekly update last week, we put our partnership with Define Logic Labs on pause for the moment, probably for Q4 at least. While everything they did for us was amazing, they tipped us off onto great strategies, gave us great insight into how to manage our allocations and how to manage our investments to maximize value. It was still a cost. There was still a consulting fee that we were paying month after month that, as of right now, that's not what the protocol needs. What the protocol needs is us to push value to the users now. And so what we did is we took any unnecessary spending and we cut it. And that includes team salaries. Everybody's been very gracious and understanding about what we need to do and what we need to focus on right now. And that's all going to be for the betterment of the protocol. And so one thing that we always try to break down is like treasury composition. This is something that we've been super committed to this whole time, is how much can we put into the DeFi fund of what we have. And so as you can see, 82.6% of the capital that we hold in the protocol is in the DeFi fund, earning yield, taking care of the protocol. And the other 17.4%, almost all of it you'll see is in liquidity pool, like in liquidity for the protocol. So I usually post data in the general chat like once a week, maybe a little more. And I did that today, where kind of just showing our basic statistics. And I think right now our liquidity is 42% of our circulating market cap. In our backing liquidity, which means just the blue chip, which means just the Matic and just the STS Plus, which is fully collateralized by USDC, just the backing liquidity is still 21% of our circulating market cap. That is extremely healthy. There's no honeypot innuendo there. Like, that is extremely healthy. If you go look at any other established DeFi protocols, that number is not 21% or 42%, no matter how you cut it. So that's important to keep in mind. Operational LP allocation is another just list of things that we have in our possession and their fiat value change. So over the month of September, this went from 101,000 to 93,000. A lot of that had to do with Matic's value loss during the month of September. Like I said, Bitcoin was green. However, a lot of altcoins weren't. Matic was not. And so since Matic is a large part of our liquidity pools, that does drag the value down for the month of September. Protocol metrics. Obviously, we spent a lot of time burning tokens in September, and because we told you we were going to. So the fully diluted value of the market capitalization was always inflated because there were so many tokens that were non-circulating. Well, we burned all those non-circulating tokens, got rid of them, and so now we have like a true FDV market capitalization. You know, it's about $680,000. And so we kind of run through this, talk about the LP treasury ratio, which I just kind of talked about. That's a little off because it counts total supply instead of just circulating supply. You have to remember there's 40 million tokens in the NFT contract that are not circulating. And the only way they circulate is through either the decay or someone redeeming an NFT. But there is no other way to get those tokens out of the contract. So they're not in circulation and they're not counted towards our circulating market cap. Other than that, like I said, pretty straightforward. Number of tokens burned, historic. We are north of 50% now. We have burned 58.3% of the total token supply. And our projected APYs are important. Single staking, there was an error in the calculation for the single staking APY. It was always around 10 to 12%. I think it's sitting at 12% right now. APYs for the farms have been pretty consistent between 30 and 35%. That's going to be like long range until we hit a point where the market picks up and the price of the token starts to increase and some more organic volume starts coming in, the APYs will probably pick up a little bit. As of right now, I have no issues with the farm APYs being in that 30 to 35%, especially if we anticipate the underlying token to increase in value. And then the projected STS Plus APY. STS Plus has been like the dark horse of the protocol. It's earned like a significant amount of return, and knowing that it's essentially a stable backed appreciating asset, like anyone who's been holding STS Plus since we launched, I think they're up almost 7% on essentially a stable coin. So it's pretty good. Everybody seems like it. That's the whole report. Let me look back and see if there's any questions. In terms of Stasis protocol, how can cross-chain interoperability be achieved, and what implications does this have in security applications across multiple? I have no intentions of making it cross-chain. Given the amount of technology that we have, the zero layer and Squid Router and Synapse and Stargate, I think protocols that are small, going cross-chain without a significant amount of capital to build out and populate your liquidity, I think is a mistake. And that's not really our lane, like you always say know your role, right? Like there's a certain humility to our role in this space. It's the DeFi fund, grow the fund, reduce the supply, and in return, we'll grow the value of the token. And that's why we designed the DApp the way we did with dynamic strategies. So you can automate it and disappear for 6 months, and your passive income will be earning passive income without your intervention. Because a lot of times in this space, we call something passive income, but then you got to do something every 24 hours. And you're like, wow, that's not passive at all. Like I have to set an alarm every 24 hours or every week to go do something. Otherwise, your income isn't your income, so it's not very passive. I saw recently some of Stasis tokens were burnt and 20,000 tokens were sent to the NFT contract. We have NFTs for sale on secondary market. I think the most used one so far is OpenSea. But we do have a mint planned for our NFTs when the market demands it. We're going to wait until people really, really want an NFT. And when they really, really want one, then we'll open up mint. Other than that, we would have to see a slowdown of people selling them on the secondary market at or near mint price. When that happens and there's still demand for NFTs, then we will consider opening up mint one more time. It would be the last time we open mint, and if Vixana doesn't get minted, we might consider doing a Vixana event where we can owner mint and redeem until we find her, and then we would thus auction off that NFT at some point. Fip, I did not do that on purpose. I did not do the 69.69 on the market. If that worked out that way, that's hilarious. But that was not intentional. I don't know how it would be. I don't even know how to calculate for tax on that. But that is funny. Let's see here. Ian posted an updated report with a hidden tag. What role does token velocity play in tokenomics, and how can projects strike a balance between high token velocity for utility and low velocity of store value? I don't think that really applies to Stasis, just because our whole protocol isn't that complicated. In fact, it's incredibly simple because it follows one of my core principles of my life, which is KISS, KISS, keep it simple, stupid. And so at the end of the day, what's going to happen long term is we are going to earn yield. We're going to use that yield to buy back tokens and destroy them. There are a finite number of tokens. no more will ever be minted. And I can promise you right now, no individual can sell more tokens than we can buy. It is impossible. They will run out of tokens and we will keep earning yield and we will keep using that yield to buy tokens. And so when people a couple earlier week ago are selling after me talking about this new strategy for 3 weeks, it's their prerogative. They're probably chasing some new protocol that's promising higher APYs. But at the end of the day, no individual can sell as much as we can buy as an institution. And so it might take some time. It might take a little while. But I promise you, given our new approach and given the yield numbers that we are seeing, there is only one direction that the chart and the token value can head long term. And especially going into this next 18 months with what we expect to have happen with the macro market for crypto overall. What innovation in states protocols can enhance user experiences in DeFi, such as decentralized exchanges, lending platforms? Again, that's more complicated than it needs to be. That's not what stasis is. Like people wonder what's on our roadmap. Like we have Stasis U on our roadmap. We're still exploring like Stasis 1 where we can implement some direct fiat to Stasis pathways and stuff. But again, our goal is to do this one thing and do it really, really well. I think a lot of protocols will make a mistake trying to be a lot of different things, especially in a short amount of time. And then they spread themselves out too thin. They lose focus on the core things that make them who they are. And then through that, they end up slipping up or making a mistake or something breaks, whatever it might be. And so I'm perfectly content with this being our one thing, and we're going to do it really, really, really well. Let's see here. Any plans to develop Android or iOS apps? Oliver, no. Those screenshots on the website are our actual dApp on the mobile phone on the browser. So if you were to go look at the website and you see any graphic that has the dApp on the phone, that's what our dApp actually looks like on the website without an app. So we are fully mobile. I don't remember the word. We work fully on the mobile app. So what you're seeing on the website, when you're seeing the dApp on the website, that's actual screen grabs of our dApp on a mobile phone. So we don't have any plans to develop an app for phone. Again, I think if the dApp works as well as it does on a mobile, the way it exists now, I would believe that would be an inefficient use of resources. You have to remember, everything we spend money on to develop now takes money away from the fund. And with less money in the fund, less yield, less value now. And so that is the double-edged sword of like, well, what are you going to build next? Well, one, do we have to? And two, is what we build going to deliver equal to or more value than what we currently have? If it doesn't, then there's no point in building it because it's inefficient. And so that's kind of my take on that whole situation. What's the minimum amount of your NFT on the secondary market? I think yesterday, FIP, you can correct me if I'm wrong, I believe it was a half a Bitcoin on the secondary, or half a Bitcoin, Jesus. Half an ETH on the secondary market, so I think about $800 or so. If there's demand for mint, what should be the minimum value of the mint? We haven't set a price for the second mint window because, well, here's the deal. We did our first mint at $600 when we started, but there was only 25 million tokens in the contract. Since then, we have added $15 million or 15 million tokens to the NFT contract since the first mint. So the backing token value of each NFT theoretically has gone up significantly. So if we were to open mint, spitballing, I would say maybe 750 or 800 for that next round of mints. But again, it would fully depend on demand. If demand is there and people are looking to take advantage of that, we would open mint. We are not motivated to open mint right now. Like I said, the market would have to dictate it. We are completely content with the collection we have at the moment, and then we would adjust as the market demands. FIP has made it very clear that there is no demand for NFTs. Don't you dare mint a single one over the 150 we currently have, because that would dilute his weekly payouts. But that is the extent of the monthly report. So I will circle back to the whole yield conversation. As of right now, through 5 days of October, some good volume days, some bad volume days. Yesterday was like a bad volume day. We're on pace to earn about 25 grand in yield for October. I'm hoping as we move through October, volumes on average pick up a little bit and we can push that number to 30 grand. And again, outside of our expenses, which is about $5,000, everything else will be coming back to the market. And so our goal is to have anywhere from 15, 20,000 or more coming back to the market until we get at least above pre-sale price and further on. It's a process, right? So like the price didn't fall to this level overnight. It took a couple months, but we're also going to have to correct that. And we've started that process. You can kind of see that because I'm still screen sharing for some reason. We have started that process. We're up almost 15% in the last week. And so that process has begun. And we will continue that process because, like I said, individuals can choose to sell. That's their prerogative. I wish them luck. But no individual can sell as much as we can buy over the long period of time as an institution. So if somebody has $5,000 and they want to sell, that's, like I said, that's their prerogative. But if we're earning $25,000, $30,000 in yield a month, it won't take long for those circumstances to work themselves out in the protocol's favor, because every buy and sell has a tax associated with it. That tax is either burned or redistributed to people who are staking and farming, and we're going to go through that process. But the key for us is we just keep working this new strategy. We keep refining. We take profit. We compound. We leverage into different allocations at different weights, and then just go from there. But it's just daily, consistent management. It's not a silver bullet. It's not some magic sauce. It's literally just day after day, Michael and I connect, evaluate, adjust, document, and then we do it again the next day. And that's our job moving forward. And we will continue to deliver that value back to you guys. Buy and sell tax. There is a 5% buy tax on Stasis, and there is a 10% sell tax. However, if you were to zap in to staking or farming, you get to skip out on the buy tax. So you can do that and take advantage of the trading volume, including the protocol buys that happen for the market. And given the dynamic nature of DeFi, what mechanisms can your project implement to ensure long-term sustainability on your ecosystems? We don't really have any plans for governance or a DAO or anything like that. The incentives for the token holders are staking and farming rewards. Again, it comes down to how we're structured. It's simple. Keep it simple, stupid. It is a fund. The token is the medium of exchange for the fund. Our job is to grow the fund reduce the token supply, and through that, the individual backing value of each token will increase over time. Now, again, if we look at the last 3 months, in the nature of the market, that hasn't played out as we anticipated. That's what this pivot to a new strategy is all about. And my hope is when we come back around and we do the monthly report for October, there will be a distinct difference in the trajectory and overall value of the fund and the token, and everybody will be incredibly happy. But yes, it comes down to keep it simple, execute. Like, it doesn't have to be this big, complicated game theory plan. It's a simple plan, and you execute it very well. I grew up playing American football, hand egg, if you want to call it that. And our high school ran a very simple wing T offense, which ran the ball like 90% of the time. And we still won most of our games because despite it being a simple playbook, we executed it almost flawlessly. And that's the plan here. Is the playbook is simple. There's no magic bullet. There's no secret sauce. It's literally just day in and day out, managing what's in front of us, maximizing its output, and then leveraging that into the market to increase the value of the token, because that's our job. Let's see here. When do you think we switch to a fund growth strategy again? I don't think we ever abandoned the fund growth strategy because we have a theory about what's going to happen with the market. The market's going to go up over the next 18 months. That's our theory, right? Until the trend is broken, we have to assume the trend will remain the same. Bitcoin in the crypto market works in 4-year cycles. And we believe over the next 18 months, everything within the DeFi fund will grow fiat value-wise significantly. And so our growth strategy isn't necessarily not happening. It's just secondary to our yield strategy. It's still there. It's just a matter of our first priority has switched from growth to yield. But at the same time, we remain holding significant beta exposure to these assets. Because like a lot of it is ETH. Like a lot of it is paired against ETH. I believe ETH is going to go north of $10,000 over the next 18 months. If that's the case, the conservative, quote, conservative asset in the fund is going to 7x. That sounds like growth to me. And so I'm not too worried about that. Is there anything upcoming token launch that the fund will be investing in for yield? No, not really. So I get this question pretty often if we invested in any pre-sales or any token launches. Personally, I will do it. From a protocol standpoint, when it comes to our risk profile, we won't do it. It's not because we don't trust anybody who's launching a token or we don't trust any protocol that's developing something. It's simply just a matter of like we established a risk protocol for a risk profile for the protocol, and it deals almost exclusively in blue chip established legacy platforms that we believe are incredibly secure and safe. Not 100%, nothing's 100% safe in this space, but we feel much more comfortable leveraging what we have in places and on assets that are very well established, very large, that sort of thing. So there is I have said before, there is a time when the market might dictate that you invest in pre-sales, kind of that euphoric stage in a bull market where you literally can't miss. Like you put money into anything and it'll 5 or 10x and then you pull it out real quick. Like there's that stage where you could allocate a small percentage of the fund for those high risk pre-sale plays, but it's at a specific time in the market cycle. There's like a euphoric stage in the market cycle where you can do that, but you have to be aware that that's what you're doing. You have to be aware that you're making that decision, you're making that gamble, because it is a gamble and you're playing chicken with an eventual collapse. But other than that, no, it's not something that we are doing. We're fully content with having the strategy that we have right now, and we're going to keep optimizing it and refining it, and through that we will deliver yield now, and we'll be able to deliver value later. Wing T, impossible to defend. Yeah, it is. It is until you come up against a team where every one of their players is bigger and faster and stronger than you. Then they will like take up 2 or 3 blockers, and everybody gets murdered. So it's nice to have at least somebody who can throw the football on your team. Is Stasis now centralized due to a few holders being greedy bastards? Yeah, I mean, you can find criticisms in any system, and I'm sure people can find criticisms in ours. Is there not enough holders? Sure. There's like 300 holders. Yeah, it's a small protocol. It's a small fund. Is too much of our fund on Uniswap? You could argue that. That's fine. There's no perfect system, and there's going to be weak spots. There's going to be weak points. There's going to be opportunities that we can deliver on. I do know that the group of holders that we have now seem committed and understanding to what we're trying to achieve. And if it never grows above 300 and we just focus on the fund we have now and the value we're going to deliver now, this doesn't need to be 100x moonshot. It doesn't need to be. It was never designed that way. It was never presented that way. It was something that we were going to deliver passive income over a long period of time. And I always joke, like, dumping isn't passive and never taking profit isn't income. So that's why we created dynamic strategies, so you could just set your take profit and walk away, because then it's just passively piling up in the form of STS Plus in your wallet. And so, but yeah, I'm sure there's somebody or someone's out there who have plenty of things to say about what we could be doing right, or definitely what we're doing wrong. But at the end of the day, I guarantee you none of them are actually running anything or in charge of anything or responsible for anyone. And so it's really easy to criticize from the bleachers. And so we just have to focus on what we can control. This is what we can control. The early results over the last week tell us that we are on the right track. We will continue to optimize and refine. But at the end of the day, we think we're onto something with the way we're operating, especially now that we've had a chance to evaluate the first few months. Maybe shake out some people who were intentionally only here for the short term. Again, that's their prerogative, but it wasn't what we communicated from day one. Day one was always long-term, slow, industrious process. And I think we've now kind of hit that sweet spot of being able to do both. Can you choose me as today's stasis winner, Falco? I mean, that's pretty bold of you. I might actually do it now. Rob, you have too many kids. If we were in a future dystopia where you're only allowed to have 2 kids, like Ender's Game, you'd be in trouble. Any other questions before I wrap this up? It is coming up on the hour. I want to make sure that we hit everything. I will post a short recap afterwards with the thank you, CoinDog. CoinDog doesn't like my pings, but he will take free stasis, so we can count him as one of our holders. I like that. Are lizard people friendly? Lizards are friendly as long as you don't stick your finger near their mouth. All right, I think we've gone off the rails here. We're going to wrap it up. Thank you, Fippa. That's just what I was about to say. We're going to wrap this up. All right, everybody. Let me pick some winners. I'm actually going to do 3 $20 stasis winners. All right. And Two of them, I already know who they are because I'm just gonna do it. CoinDog and Falco. You guys both $20 in stasis because I'm in charge and I can do whatever I want. And the last one, just because the third and final winner of $20 in stasis is going to be Sir Cork, because I think that name is funny. So Sir Cork, CoinDog, and Falcao. I don't know how to say your name. If you three can open up a ticket, we will get you guys $20 in stasis. That's it. I will post a summary and the report for you guys to review. Like I said, this one's got a lot of lines because this fund was in transition in September, but the early results of what we're trying to accomplish with the new strategy are very promising. So I appreciate everybody's time. If you three can open up a ticket, we'll get you guys some stasis tokens, and then we will see you guys next week. And I look forward, actually, most importantly, I look forward to next month's monthly update, because I feel like that will be the distinct empirical evidence that what we're trying to accomplish with this new strategy is real, it works, and it's delivering the results we wanted. So thank you all for your time. I hope you have a great weekend.